Joining us for our weekly wrap-up is Mark Wenzel from the Hopkins Group. Good morning, Mark.
G'day, Michael. How are you today?
Good, thanks, mate. Now, it's been another interesting week in the markets, and there's been a couple of key data points which are going to impact the RBA when considering whether or not to raise rates next Tuesday. Let us know what those points are, Mark.
Yeah, absolutely. So after the last inflation report, that was sort of 7.8%, which was obviously higher than what the market was expecting. The main causes for the rise were domestic and international travel and accommodation, as well as, obviously rising electricity bills, which we, from an electricity point of view, we expect to continue throughout 2023. But the RBA had forecasted inflation to peak at 8% in the December quarter before retreating in 2023. One of the other key factors of the inflation number was that electricity inflation was impacted by the government in Western Australia unwinding its energy credits of $400 million. So, not having those supplements meant that obviously the price in WA went up, which obviously impacted consumer inflation as well. So certainly from that point of view, the number was high, but that's not as high as what the RBA were expecting. The other key factor was that was reported last week was that retail sales figures were down 3.9% seasonally adjusted. The main reason cited for the decline was consumers bringing forward Christmas spending to the November Black Friday sales and other sales throughout the November period. And the CBA credit and debit card spending data to January, though, suggests a slowing in retail spending, but not a slowing in non-retail items such as restaurants and travel, which was very solid. The RBA is meeting next week, and there's a 97% chance that the rise will be put through at 0.25%. But I don't think they should, and I don't think they should for the following reasons. They had expected inflation to peak in the December quarter, and the rate came in a little bit lower than what they had predicted. The second point was that not all interest rate rises to date have been impacted by mortgage holders. So with fixed rates rolling off over the next 3 months, the move in the number of variable rate mortgages will move from sort of 50% of the total mortgages to about 70%. So we're going to have a big increase in the number of people that are exposed to the variable rate mortgages, and for many of them, their cost of mortgage repayments will double over the next 3 months. The bulk of the other 30% of mortgages roll off through 2023. The third reason I don't think they should is that there's the large pool of savings that have been built up over COVID is starting to be spent, and you're starting to see in the figures that's coming down. But one of the key things that happens in a time of uncertainty is people hoard money. So perhaps that cash savings is not going to be spent. So therefore, it's not going to be as inflationary throughout the year. With the money being kept rather than spent. The fourth reason I felt that they shouldn't raise interest rates was that mortgage payments as a share of household debt has reached a record high was expected to reach a record high in the middle of the year at 28% of total income. This breaks the previous record set in 2008. And again, if you're spending 28% of your income on mortgage repayments, there's not necessarily a lot left over to fund all the other expenses that we have in life. And the fifth reason I cited for a reason for the RBA not to raise rates and just to pause and see how the effects of the rates, the increases that they've made so far, is that the energy costs, as we talked about, have risen, are forecast to rise by 30% this year, and insurance costs are skyrocketing, which again is all going to add to the drag on spending. While these are going to add to the inflation, it is going to mean that consumer spending in other areas is limited because of the lack of income. My thing is it's an important decision for the RBA. They are likely to raise rates on the back of financial market pressure and the desire, I guess, to really sort of try and stamp out that inflation, which again is really important for them to do. So they're likely to do it. But I think pausing for the next couple of months to see how the raises that they've done so far are impacting the economy, and also to how much the additional household expenditure that we're going to have is going to reduce the spending in the economy. So really fascinating to see how it goes next week.
Yeah, if they slam the brakes on too hard, it's pretty hard to get it going again, isn't it?
Absolutely. And, we've seen a lot of people sort of reference the US, but I mean, they've got fixed rates for 30 years. If you locked your rate in at, back in 2020, 21, they're fixed for 30 years. Whereas in Australia, obviously, we've got a far greater proportion of variable interest rates. So the rises that they've had so far, will work and they will slow the economy. And so it's just a question of, how long it takes. And as I say, from whether the RBA pushes too hard.
Could we see this affecting employment if consumer spending drops off that much? Could there be employment repercussions?
Well, absolutely, and I think that's what obviously the RBA wants, though. They want to slow the economy to get the inflation down. I mean, it's inflation's something that they really do have to get the knock on the head, because it is insidious in the economy if it gets in, and if wage rises start to base on inflation figures and those sort of things, then it becomes entrenched, and they don't want it to become entrenched because it's really hard to get rid of, and so they do need to squash it on the head, but it's just a question of whether the 3% rises that they've given so far are going to, pull the economy back to where it needs to be and get it working towards that 2 to 3% target zone.
All right, Mark, we'll leave it there and we'll chime in next week, and fingers crossed the RBA is tuned in and listening to those 5 excellent points.
Excellent. Thank you, Michael.